Welcome to the deep dive. If you've been watching the markets at all lately, you know the air is thick with anticipation. We're talking about global financial markets perched right on the edge of their seats, where every tick, well, it could signal a tectonic shift.
It truly feels like a pivotal moment. You can almost feel the tension crackling, especially what's looming just ahead.
Absolutely. And our mission today is to cut through all that noise. This deep dive is all about navigating the incredibly complex, fast-moving world of global foreign exchange markets over the next, say, 24 hours. The central tension. We've got this major U.S. tariff deadline clashing head-on with wildly divergent central bank monetary policies around the globe.
Hmm.
And this isn't just about understanding what makes currencies move, it's about grasping the underlying forces shaping entire economies right now. We're here to give you that shortcut to being truly well-informed, zeroing in on the most important insights without, overwhelming you.
Right. And our approach is, well, it's to peel back those layers of data for you. From the real-time market movements you can see on the screens, to the subtle signals whispered from central banks, and even what the collective mind of retail traders is thinking. It's about building a truly comprehensive, yet hopefully digestible picture.
Okay, let's unpack this. Our foundation for this deep dive is what the market is literally telling us right now. When you look at the raw, real-time market data from the last 24 hours, what's the price action hinting at?
Well, there's a clear cautionary tone across the board. Key pairs are showing guarded price action. Euro USD, for instance, is holding near multi-year highs. But here's where it gets really interesting. USD JPY is actually being bought.
Bought, despite dollar weakness elsewhere.
Exactly. And this isn't necessarily a sign of broad U.S. dollar strength. It seems more about a dominant underlying weakness in the Japanese yen itself. And if you look at commodity currencies like AUD USD, they're pulling back from recent highs, which is a classic signal of traders turning risk averse.
So, caution, but with some very specific stories playing out. That makes sense. Are traders actually committing capital, or are they just waiting for the shoe to drop? What are liquidity and volume telling us?
The market shows stable but, cautious depth. Trading volumes are moderate, which is pretty typical before a major event like this.
Okay.
However, we have seen notable spikes in activity around any news related to U.S. tariffs.
Okay.
This tells us traders are poised to act, but they haven't made huge directional bets just yet. It's that classic positioning phase ahead of a big announcement.
Speaking of positioning, let's talk about the absolute bedrock of market movements, overnight interest rates. What are the big central banks doing right now? The Fed, ECB, BOJ?
Okay, so the Federal Reserve's Fed funds rate is holding stable, reflecting their recent neutral stance, which kind of anchors the dollar.
Right.
The European Central Bank, on the other hand, recently cut its deposit facility rate to a new low of 2.00%. That's a clear dovish pivot, fundamentally bearish for the euro.
Right, a big...
And then we have the Bank of Japan. Their overnight call rate is at 0.50%, but with distinctly hawkish forward guidance. They're hinting at future hikes, which is, well, it's a world away from the ECB.
That policy divergence is practically screaming at us. But here's a critical contradiction that jumps out from the data. Despite this looming tariff deadline, volatility metrics are surprisingly low. The VIX index, often called the market's fear gauge, is trading down at 16.38, and implied volatility on major currency options remains subdued. What are we to make of that?
Yeah, that's a great point. This is what we often call a volatility trap.
Yeah.
It means the market isn't buying insurance against a collapse. That is, traders aren't piling into options that would typically surge in value during extreme market moves.
Okay, so they aren't buying puts, essentially.
Not in big numbers, no. Instead, they might be expressing their views or hedging through direct spot and futures markets. This suppresses implied volatility, the vol you see in options, and potentially sets the stage for an explosive release of that suppressed volatility if the tariff announcement is worse or, significantly different than what's currently expected.
So it's less a sign of no risk and more the calm before a potential storm.
Exactly. It's not complacency, it's just manifesting differently, perhaps.
A volatility trap. That's a perfect way to put it. So it's not complacency.
Got it. Let's quickly scan the economic calendar for the last 24 hours. Were there any major data releases that shaped sentiment?
In the Eurozone, yeah, we saw weaker than expected retail sales and producer price index data. This just reinforced the narrative of a slowing economy, absolutely justifying the ECB's recent rate cut.
Made their job easier, maybe. You could say that. For the United States, we didn't have any top-tier data, keeping the market focused squarely on that tariff deadline and upcoming employment figures. Japan had no major announcements. But the market continues to digest those hawkish comments from BOJ board member Takata we mentioned.
Right, Takata's comments are still echoing.
They are. And in Canada, weak services and composite PMI data are adding pressure to the Canadian dollar.
So, a quiet US, but clear weakening signals from Europe and Canada. How about the central bank messaging itself? Are they giving us any subtle clues reading between the lines of their speeches or publications?
The Federal Reserve's recent publications have been quite academic, actually, focusing on topics like how monetary policy transmits through the dollar or trade costs and inflation dynamics. We haven't had direct forward guidance in the last 24 hours, but earlier remarks from Chair Powell and recent stress test results generally suggest a resilient but cautious central bank, still data dependent.
Okay, cautious Fed. And the ECB, after that rate cut, what's the narrative they're pushing?
The minutes from their latest monetary policy meeting confirmed the rationale for the rate cut, really emphasizing their commitment to the 2% inflation target. A speech by Frank Elderson also highlighted the economic threat from what he called natural decline, hinting at the ECB's broader strategic focus, perhaps beyond just inflation. But the overall tone is unmistakably dovish. They're doubling down on that rate cut message.
Which brings us back to the Bank of Japan, because that's where things get really interesting, isn't it? That divergence is almost extreme.
It absolutely is. The most significant recent message came from board member Hajime Takata. He stated the BOJ is only pausing policy rate hike cycle and may need to quickly shift back to raising rates.
Wow. Quickly shift back, that's direct.
Very direct. It's a strong, hawkish signal, creating that stark policy divergence with the dovish ECB and a potential conflict, or at least a difference, with a neutral Fed. It's a very loud message from Japan.
Okay, so we've got the market telling us caution, central banks diverging wildly, and this underlying volatility trap situation. Now let's talk about market positioning and sentiment. Who's actually doing what out there? What do the commitment of traders reports tell us about the big players, the leveraged funds?
Right, the COT report. The most recent data, which reflects positions up to July 1st, indicates an increase in net long USD and net short JPY positions by leveraged funds. This reflects that popular carry trade strategy we were touching on.
Ah, yes, the carry trade. Maybe quickly explain that again.
Sure. For listeners who might not be deep in FX trading, a carry trade is essentially borrowing in a currency with low interest rates, like the yen has had for ages, and investing in a currency with higher rates, like the US dollar currently. The idea is to carry or profit from the interest rate difference. It's a very popular strategy when rates diverge this much.
Makes sense. Borrow low, invest high. And what about the retail client sentiment? This is often where we find those surprising contrarian signals. The everyday trader, what are they doing?
It definitely is often contrarian. Looking at Forex.com data for EURUSD, a staggering 86% of retail clients are net short.
86% short EURUSD.
Yeah, it's huge. This is an extremely crowded trade and historically a powerful contrarian bullish signal for the pair. Think of it like this. If almost everyone is betting one way and the retail crowd is often, on the wrong side of big moves, the smart money often looks to bet the other way.
So potential fuel for a rally if they get squeezed. What about USDJPY and AUSD?
For USDJPY, 58% are net long, a smaller majority. So it's less of a strong contrarian signal. Still leaning long, but not extreme. And for AUASD, 55% are net long, which means retail investors are buying on dips as it falls. This is a slight contrarian bear signal suggesting they might be trying to catch a falling knife, as they say.
That's a clear disconnect then, isn't it? High geopolitical uncertainty from those impending tariffs, yet surprisingly low implied market volatility, and retail piling into specific directions. Why isn't the market pricing in more fear in those vol metrics?
It circles back to that volatility trap idea, I think. The market might be positioned for a specific, perhaps manageable, outcome from the tariffs via spot or futures. If the announcement deviates significantly from those expectations, either much worse or maybe even surprisingly better, that suppressed volatility could be released explosively. It's not necessarily that traders aren't concerned, it's that they might be expressing their views through different instruments than options, which don't directly impact implied volatility metrics like the VIX as much.
Right, different ways to place your bets. Okay, so with all that foundational data, the market action, the central banks, the sentiment, how do we filter for opportunities? We meticulously went through this information to identify the 5 most compelling currency pairs for this deep dive, aiming for a diverse portfolio of potential moves. What were our key filtering criteria?
Okay, first we looked at volatility, using metrics like average true range, ATR, and historical volatility. This showed increased movement in USD-related pairs naturally due to tariff news, and also JPY crosses because of that BOJ speculation. Then, liquidity. Super important, ensuring we're focusing on pairs with deep markets where you can get in and out easily. Major pairs like USD, USD-JPY, GBP-USD, and AUD-USD consistently show the highest liquidity. Interestingly, USD-MXN, despite being an emerging market currency, also exhibits significant liquidity due to its close ties with the U.S. economy.
And volume, of course, gives us a real sense of trading activity, who's participating.
Exactly. Futures volume data from CME Group confirmed high trading activity in USD and USD-JPY contracts, backing up their liquidity. We also monitored social media, specifically looking at trending keywords like tariff, Trump, Fed, and ECB on places like financial Twitter and Reddit's r4x. This confirms that these macroeconomic narratives are really driving retail investor interest and discussion. They're talking about what we're talking about.
Good sanity check. And the overall news sentiment from major outlets. Sentiment analysis of headlines from places like Reuters and Bloomberg revealed high uncertainty and a slight risk-off bias, generally focusing on the potential negative impacts of tariffs. So, caution in the headlines, too. And crucially, we looked for contrarian signals. That extreme net short positioning of retail investors in USD was the most significant anomaly we found, making it a prime candidate for a closer look.
Got it. So, given all those filters, we landed on our chosen 5 for this deep dive. Let's list them for everyone. USD, USD-JPY, AUD-USD, UR-JPY, and USD-MXN. For you, the listener, we're now going to unpack each of these 5 critical pairs through multiple lenses. Their technical picture, underlying fundamentals, cyclical patterns, the latest sentiment, and what our advanced AI simulations are predicting. Let's start with USD, which we've called bullish momentum facing macroeconomic headwinds. From a technical perspective, what's the story emerging from the charts? Okay, technically, USD is in a clear short to medium term uptrend. It's trading within a rising channel and actively testing multi-year highs, specifically around the 1.1800 to 1.183 area. Big level. However, and this is key, we're seeing a bearish engulfing candle on the daily chart. That's a classic reversal signal suggesting a potential downward correction is brewing.
Like a strong rally hitting a wall.
Exactly. Think of it like that. This level also happens to coincide with the 78.6% Fibonacci retracement of a prior major decline, which often acts as significant resistance. While price is currently above all key moving averages, which is bullish overall, it's also quite stretched from its short-term averages, like the 9 or 20-day.
And what do the indicators like RSI and MEXD tell us? Are they confirming this potential exhaustion?
They are. The RSI 14 is way up at 78.9. That's deep into overbought territory, signaling the rally might be exhausted and a reversal, or at least a pause, is due. The MACD, while still positive, is showing signs of a potential bearish cross, indicating weakening upward momentum. So the technicals are a bit mixed, but leaning towards a short-term bearish correction. A sustained break below 1.1758, which is a key near-term support level, S1, would likely signal a deeper correction. But if it somehow manages to break decisively above 1.1830, that would be an extremely bullish signal, likely triggering stops.
Okay, so the charts are signaling caution, maybe a pullback is more likely near term. But what about the fundamental and quantitative dynamics? How do those central bank policies we talked about earlier, the Fed versus ECB, play into this for EURZD?
Right, the fundamentals. The primary driver here is the clear monetary policy divergence. The ECB has cut rates to 2.00% and remains quite dovish due to weak Eurozone economic data. Meanwhile, the Fed is holding steady at higher rates. This creates a positive yield differential favoring the USD, which fundamentally is bearish for Eurozone.
So money flows to the higher yield.
Generally, yes. Your money earns more in dollars than in euros right now, based on policy rates. Plus, recent Eurozone data has been generally weak, while U.S. data has been comparatively stronger, reinforcing that bearish fundamental case for the pair.
And from a cyclical perspective, looking at shorter-term momentum, what are we seeing? Is the market due for a breather based on recent moves?
Yeah, cyclically, the 7-day momentum is strongly positive, but clearly decelerating right at this resistance level we highlighted. This suggests conditions are ripe for what we call a short-term mean reversion trade.
Meaning a pullback towards the average.
Exactly, like a stretched rubber band snapping back towards the middle. The current price is actually more than 2 standard deviations above its 20-day moving average. That's a statistically significant deviation that very often precedes such a mean reversion, or at least a pause in the trend.
Now, for the sentiment profile, and this is where that incredible 86% net short retail positioning comes in for Euro year, what does that mean and why is it so striking?
This is truly the most striking detail for this pair, and it's an extremely powerful contrarian indicator. Historically, when retail sentiment becomes this one-sided 86% short, it very often precedes strong moves against the retail crowd. It potentially leads to what's called a short squeeze.
Explain that squeeze again quickly.
Sure, it's when all those people betting on a fall, shorts, start losing money as the price moves up. They're forced to buy back the currency to close their positions and limit their losses. This wave of buying pressure can actually drive the price even higher, faster. It feeds on itself.
And the big players, are they short too?
Institutional positioning from Catry reports also shows large speculators net short euro, which adds another layer. Are they starting to close these positions? If so, that would only fuel a potential rally. And remember that low VIX we discussed. It indicates a lack of systemic fear, which paradoxically can allow existing trends, like this Yuri-Hosdy uptrend, to extend longer than expected before reversal. The US dollar index, DXY, trading near multi-year lows, also provides a general tailwind for Yuri-Hosdy. But a DXY rebound, maybe driven by tariff-related safe haven flows, is the main risk to the upside here.
This is where our AI simulations become invaluable, trying to weigh these conflicting signals, bearish technicals fundamentals versus bullish contrarian sentiment. What's the output for UHESI?
Okay, our Monte Carlo simulations run over 10,000 scenarios for a 24-hour horizon actually show a bimodal distribution.
Bimodal, meaning two main likely outcomes.
Exactly. The highest probability cluster is a slight downward correction to the 1.1720, 1.1750 area. That mean reversion we talked about seems likely. However, there's a significant fat tail on the bullish side. This indicates a non-trivial probability of a massive short squeeze taking the price up towards 1.1850 or even higher. It's a real possibility. Our Bayesian model, which constantly updates with new data, initially assigned a 65% probability of price being lower in 24 hours based on those overbought technicals and the fundamental divergence.
Okay, so leaning lower initially.
But crucially, when it incorporates that extreme retail sentiment as a strong contrarian signal, the model actually adjusts this probability down to just 55% lower. It acknowledges the very high risk of that short squeeze potential. And our whale watching algorithm, tracking large orders, are detecting significant pending buy order support down in the 1.177 volatility-1.1720. But interestingly, there's a distinct lack of large sell orders resistance visible above 1.1850.
So support below, but clear air above.
Potentially. It suggests a breakout above that 1.1830, 1.1830 area could accelerate quickly if key levels are breached.
Fascinating. A complex, almost paradoxical picture for Euro-USD, a real tug of war. Let's move on to USD-JPY, which we're calling the safe haven dilemma. What do we see here across our lenses? Technicals first.
Technically, USD-JPY is holding above the key 140.00 support level, despite some broader USD weakness we saw elsewhere. It's currently testing resistance near the 145.00, 146.000 zone. RSI and MACD are neutral to slightly bullish, but not really screaming conviction either way. It's more of a grind higher.
And fundamentally, this is that big policy conflict zone, right?
It really is. You got those hawkish comments from the BOJ contrasting sharply with a neutral Fed. Now, normally, tariff news or risk-off events should benefit the JPY as a safe haven, driving USD-JPY down. But paradoxically, the pair is rising. This indicates that either the carry trade demand that hunt for the USD yield advantage or perhaps deep inherent JPY weakness is overriding those traditional safe haven flows right now.
So the carry trade is winning over safe haven flows for now. What about cycles and sentiment?
Cyclical analysis shows positive momentum on shorter-term charts. It has broken out of a recent consolidation range, so the trend is up short-term. Sentiment-wise, retail sentiment is 58% net long. As we said, leaning long, but not extreme enough to be a strong contrarian signal like in Euro-USD. It seems the market, for this pair, is focusing more on the risk-on aspect of those widening yield differentials, largely ignoring the risk-off tariff narrative for now.
And the AI simulation.
Our AI simulation output suggests a high probability of a continued slow grind higher towards that 146.000 area. But it also flags high sensitivity to a sudden risk-off shock. If bad news hits unexpectedly, it could trigger a rapid reversal downwards in USD-JPY. Very sensitive to surprises.
Okay, interesting dynamic there. Next up, IUD-USD, which we've labeled the risk barometer. What's its story telling us? Does it live up to the name?
It certainly seems to be right now. Technically, it's showing clear weakness, pulling back sharply from recent highs. We're seeing bearish signals in the daily chart, with key support down at 0.6500 looking vulnerable. RSI and Matsudi are both falling, confirming the downward momentum.
And fundamentally, it's all about risk and trade.
Pretty much. AUDSD is acting as a pure barometer for global risk sentiment, especially related to trade wars via China, and is highly sensitive to commodity price fluctuations. The Reserve Bank of Australia, RBA, is considered dovish, maybe less so than the ECB, but certainly not providing any independent strength to the Aussie dollar right now.
Cyclical and sentiment view.
Cyclical analysis indicates short-term momentum has firmly turned negative. The pair is clearly in a corrective phase of its recent uptrend. It's rolling over. Retail sentiment is 55% net long again, folks buying the dip, which acts as a slight contrarian bearish signal. It suggests the path of least resistance might still be lower. The AUD is fundamentally a risk-off sensitive currency, and the current environment with the tariff deadline definitely leans in that direction.
So the AI probably points lower too.
Yes, the AI simulation output predicts the highest probability is testing that 0.6500 support level in the next 24 hours. It also shows a strong inverse correlation with the DXY, the US dollar index. If the dollar strengthens on risk aversion, AUD-USD likely falls.
Now, one of my favorites, because the numbers are just so stark, EUR-JPY, which we're calling the pure policy divergence trade. This one has some jaw-dropping sentiment figures, doesn't it?
It absolutely does. It's maybe the most extreme sentiment reading I've seen recently. But first, technically, this pair is in a strong, clear uptrend within a well-defined rising channel. It recently hit new year-to-date highs. Very strong trend. While the RSI is overbought, which normally signals caution, the momentum here is undeniably strong. All the moving averages are perfectly aligned in a bullish configuration. It looks technically powerful.
But fundamentally, shouldn't ECB cutting and BOJ hinting at hikes be bad for EUR-JPY?
Logically, yes. A dovish ECB cutting rates versus a hawkish BOJ hinting at hikes should theoretically be bearish for this pair over the medium term, perhaps. However, right now, the market seems entirely focused on two things: the current positive yield differential, you still get better returns holding euros than yen, and the sheer momentum of the broader risk-on carry trade dynamic that's lifting pairs like this.
So momentum and current yield are trumping future policy hints for now, cyclically.
Strong positive momentum across all short and medium-term timeframes. It's just powering higher.
Okay, now that sentiment profile you mentioned, it's off the charts for this one.
It really is. We're seeing extreme retail net short positioning a truly staggering 94% net short.
94%. Almost nobody in the retail space thinks this goes higher.
Pretty much. And this is a massive contrarian bullish signal. It indicates a powerful short squeeze is likely actively unfolding for this pair right now. All those shorts are potentially fuel. Our AI simulation output for EUR-JPY reflects this clearly. It shows a very high probability of the uptrend continuing in the next 24 hours. The model specifically highlights this extreme retail sentiment as the single most dominant predictive variable for this pair in the short term. It's almost a textbook example of the crowd being caught on the wrong side of a strong trend.
Incredible potential feedback loop there. Finally, let's look at USDMXN, which we've dubbed the tariff epicenter. What are the layers telling us here about its vulnerability to this specific news?
Okay, USDMXN. Technically, this pair has seen significant volatility recently, as you'd expect. It broke above long-term resistance near 18.50 and is currently consolidating its gains around 18.70. Technical indicators are bullish, reflecting the recent move up, but they do appear stretched, signaling it's had a strong run already and might be due for a pause or pullback, absent news.
But the fundamentals are all about the T-word here.
Almost entirely, yes. The analysis here is dominated by the potential impact of U.S. tariffs on Mexico. A 25% tariff, as threatened, could potentially reduce Mexico's GDP by something like 2.5% to 4%, according to some estimates. The automotive and electronic sectors look particularly vulnerable.
Are there any mitigating factors for the peso?
There are a few. The peso's own depreciation actually makes Mexican exports cheaper, which could offset some tariff impact. There might also be potentially inelastic demand from U.S. consumers for certain Mexican goods. Also, high interest rates from Banxico, Mexico's central bank, provide some underlying support through the carry trade angle. It's attractive to hold pesos from a yield perspective, but that's likely secondary to the tariff news right now.
And cyclically and sentiment-wise?
Cyclically, the pair is in a clear, news-driven uptrend cycle. The trend is up because of the tariff fears. Sentiment is largely driven by fear and uncertainty. Any news or even rumors regarding tariffs trigger immediate and strong price movements in USDMXN. It's very twitchy.
So the AI must show huge potential swings.
Exactly. The AI simulation output for USDMXN indicates extremely high volatility and a very wide potential price range over the next 24 hours. The forecast heavily relies on the binary outcome of the tariff announcement. The baseline assumption built into the model, assuming tariffs are implemented as threatened, suggests a move above 19.0 is quite possible.
Okay, so we've pulled back all those layers of data and insights for these 5 pairs. A lot to digest there. Now let's bring it all together for you. It's time for our synthesis and your 24-hour outlook. How do we resolve some of these conflicts we found, like sentiment versus technicals, and find agreement across the models? Let's start with URSD again.
Right, synthesis time. For EURUSSD, the main conflict is stark. Bearish technicals and fundamentals versus that extremely bullish contrarian retail sentiment. Our AI models actually give significant weight to the contrarian signal here, suggesting the risk of a short squeeze is just too high to ignore completely, despite the bearish signals elsewhere. So our forecast is a sideways to slightly bearish bias for the immediate 24-hour term, but with a high probability of volatility spikes in both directions. The general medium-term trend might still be upward, but immediate pressure seems downward unless that squeeze kicks in hard.
So low confidence, high potential for fireworks. What about USD JPY? That safe haven versus carry trade conflict. How does that shake out in the forecast?
Here, the conflict is between the risk-off tariff theme, which should strengthen the JPY, pushing USD JPY down, and the risk-on carry trade theme, which weakens the JPY, pushing USD JPY up. Currently, the carry trade is clearly prevailing, showing its strength and resilience. So we forecast a continued slow appreciation for USD JPY, a grind higher, but with the critical caveat that this pair is highly susceptible to a sudden reversal if a genuinely negative tariff surprise hits the market and risk aversion spikes hard.
Okay, carry trade wins for now, but watch out. RUGSD seemed pretty straightforward, if I recall. Did all the models agree?
Is the most straightforward, yes. All our models, technical, fundamental, cyclical, and even the slight contrarian sentiment signal point in the same direction. Bearish. The risk-off mood stemming from the tariff situation is the dominant factor for the Aussie dollar right now. High confidence and a bearish bias.
URJPY with that insane retail short positioning. What wins out there in the synthesis? Fundamentals or the squeeze?
Similar to URAS, there's that theoretical conflict between fundamental factors, policy divergence theoretically being bearish long-term, and the overwhelmingly bullish sentiment and technical signals right now. But the sheer scale of retail short positioning, that 94% net short, makes the bullish case overwhelming in the immediate short term. A short squeeze appears to be the primary driver. High confidence and a bullish bias driven by that squeeze.
And USD-MXN sitting right on that tariff fault line. Any conflict there?
No real conflict in direction, just magnitude. All models are in agreement here. The direction is almost entirely dependent on the tariff news outcome. The inherent risk clearly points towards MXN weakness, meaning USD-MXN moving higher, especially if tariffs are confirmed. This is a direct event-driven play.
How do we translate all this into potential price ranges for the next 24 hours, giving our listeners something tangible to think about?
We use metrics like the 14-day average true range, ATR, and the current low implied volatility to calculate potential 1 and 2 standard deviation ranges. Think of these as the typical bounds where price tends to move in a day, centered around its daily pivot point, but then adjusted directionally based on our forecast trend. And importantly, for pairs like USD-MXN, where you have a binary event risk like the tariff announcement, we apply an additional stress factor to account for potentially much wider swings than ATR alone would suggest.
Right, got to account for the news bomb potential. So for example, USD's range.
Yeah, for instance, for USD, based on its ATR and our sideways bearish bias, a typical 1 sigma move might be around plus minus 42 pips, and a 2 sigma move plus minus 84 pips from the pivot, but the squeeze potential adds upside risk beyond that.
Got it. And finally, our confidence scores. This is where we distill how much conviction we have in each forecast, looking across all 5 of our analytical layers: technical, fundamental, cyclical, sentiment, AI.
Exactly. We assign a proprietary score from 1 to 10 based on the level of consensus across those 5 analytical layers. A high confidence score, say 8 to 10, means pretty much all 5 layers point in the same direction. We saw that with IDSD bearish and the URJPY bullish squeeze. Medium confidence, maybe 5 to 7, means most layers agree, but there are significant conflicting signals from 1 or 2 layers, like what we see with USD-JPY, carry versus risk-off, or USD-MXN, event-driven. And low confidence, 1 to 4, means major conflicts exist across multiple layers, creating a highly unpredictable environment in the very short term. That was EURUSD, with its sentiment versus technicals fundamentals battle.
All right, let's put it all together. Here's your strategic insight summary table for the next 24 hours. URUSD. Retail, 14% long, 86% short. Are a trend. Sideways bearish bias, Potential range, roughly 1.1685, 1.1790, but watch for squeeze. Confidence, low, 410. USD/JPY retail, 58% long, 42% short. Our trend, bullish bias, potential range, 144.80, 146.10. Confidence, medium, 610. IU/USD retail, 55% long, 45% short. Our trend, bearish, potential range, 16450, 16540. Confidence high, ADIO/XUJTY retail 6% long, 94% short. Our trend, bullish, short squeeze. Potential range, 18.60, 17.21, highly news dependent. Confidence, medium, 710. Okay, based on all that analysis, the highest confidence strategic implication that emerges for you, the listener, is a long position in URJPY. This pair scored the highest confidence score, 910, due to the strong consensus across its technical picture, its positive momentum, and that absolutely overwhelming contrarian signal for market sentiment. This truly makes it the standout candidate for a detailed strategy based on our work today.
Absolutely. It's where the different layers align most strongly towards one direction, at least in the near term. So for a detailed strategy concept on URJPY, we suggest considering going long, meaning buy URJPY. The reason is that powerful combination: strong technical uptrend, robust positive momentum, and that extremely powerful short squeeze signal from the 94% net short retail position acting as potential fuel.
Where might an entry point be?
For an entry zone, one might consider buying on price pullbacks towards dynamic support levels. For example, the 9-day exponential moving average, which is currently around the 169.30, 169.6 area, looking for a dip to join the trend.
And targets and risk management.
A potential take-profit TP target could be 171.50. That's near a psychological round number and also lines up with an extension target of the current rising price channel. Crucially, a stop-loss SL should be placed to manage risk, perhaps around 168.80, just below the nearest significant structural support area. A break below there would likely invalidate the immediate bullish scenario.
And the risk-reward on that setup?
Based on those hypothetical levels, the approximate risk. Reward ratio for this trade idea is quite attractive, around 1 to 3.8, meaning you'd be risking about 50 to 80 pips for a potential profit of roughly 190 to 220 pips. Favorable or rare.
There you have it, a deep dive into the data, the sentiment, the conflicts, and a high conviction idea emerging from the synthesis. You've just experienced how peeling back those layers can cut through incredibly complex market information, revealing surprising facts like that URJPY sentiment and crucial insights. Remember, true knowledge, or at least better understanding, comes from not just what is happening, but digging into why it might be happening and how different pieces of information fit together, or sometimes how they spectacularly conflict, like in USD.
Exactly. It's about understanding the entire ecosystem, the pushes and pulls.
And as we look beyond the immediate 24-hour horizon and this impending tariff deadline,
what hidden factor, perhaps something currently flying under the radar, could emerge in the coming days or weeks to completely shift the dynamics of these currency pairs we've discussed? What's the next story?
something to think about as you continue to observe the markets. Until next time, stay curious.